A new type of mutual fund was introduced in late 2007 by the fund industry called managed payout funds. The goal of these funds is to give retirees a steady stream of income. At the time, they were touted as being an easy way for investors to get regular income payouts, professional money management, and relatively low fees. Early players in the managed payout fund arena were Fidelity, Vanguard, John Hancock, Charles Schwab, all very big players. What happened is these funds ended up demonstrating something known as the sequencing of returns problem for retirees. The sequencing of returns problem is this. If a retiree experiences losses early in their retirement, the principal is very quickly depleted, and the amount of time until the retirement portfolio runs out of money is significantly reduced. Well, just like the new retiree who experienced losses early on, these managed payout funds were decimated by the stock market plunge of 2008-2009. So just a few years after their inception, many of these funds were unable to meet their obligations to retirees and were basically returning principal. According to a Morningstar analyst, he said the plight of managed payout funds dramatizes boldly what can happen to investors if they experience a serious market downturn early on, when they're starting to draw down their payments in retirement. That's from Dan Culleton, who's a fund analyst at Morningstar. The sequencing of returns problem comes not when you are in growth mode, okay? Then it doesn't matter. Because regardless of whether a portfolio experiences weak or strong returns early on, the ending market value is going to be the same. Let's just look at an example. Assume that we have two portfolios, X and Y. Each one starts with $500,000. Neither one's taking withdrawals. Portfolio X experiences early losses. Portfolio Y, the one on the right, experiences early gains. Now, as you can see from the chart below, there's no difference in the ending value on the left and the right hand side when there are no distributions being taken. But that is definitely not the case once you begin taking distributions. Again, you're looking at the same sequence of returns on the left and the right hand side. Now what we're doing is we're starting with $1 million at age 65, and we're going to take a 5% withdrawal each year, adjusted upward by 3.5% for inflation. Portfolio X on the right hand side experiences the losses early on and runs out of money, on the left hand side, runs out of money in less than 20 years. Portfolio Y on the right hand side has strong early returns and is still going strong at age 100. The sequence of returns, or the average return, is exactly the same in both cases, right? Both of them average a 6.5% return. The only difference between the left and the right hand side is that we've reversed the sequence. And the difference in the two outcomes, once you start taking distributions, becomes massive. What this demonstrates is a tragic flaw in the traditional capital appreciation portfolio when your investment objective is income replacement, meaning that at some point in the future you're going to have to start taking distributions in order to replace your W-2 income. The fact is there is just too much dependence on luck. You are basically betting on a random sequence of numbers over 30 years, and the consequences, if your bet doesn't pay off, as you can see from that illustration, can be absolutely catastrophic. So let's talk about how cash flow solves the sequencing of return problem. First, a little primer on cash flow versus capital appreciation. Capital appreciation is when you buy something in hopes it will go up in price, with hope being the key word there. And when it does, you sell it for more than you paid for it, and the profit is called capital appreciation. Cash flow is money that comes to you while you still own the asset. And examples of cash flow would be rent, royalties, interest, dividends, and option premiums. Those are the 5 sources of cash flow other than your job. The key characteristic of cash flow is that you don't have to sell the asset in order to make money. Another important characteristic of cash flow investments is that cash flow is typically, not always, but typically tied to the amount invested rather than its market value. So let's just take a bond as an example. The yield is a percentage of the face value. A $1,000 bond paying 6% will pay $60 in cash flow whether the bond is worth $900 or $1,100. So imagine that your monthly expenses are $9,000 a month and your portfolio generates $12,000 a month in cash flow. So long as that $12,000 isn't connected to the market value of the portfolio, then the sequencing of returns problem goes away. Your portfolio withdrawals would be unaffected by the sequence of returns because there is, in a cash flow portfolio, there is no need to sell assets when the market is down, assuming, of course, that you started with enough money to begin with to create enough cash flow to be able to pay your bills. That reverse compounding that occurs when assets are liquidated at a loss to raise cash is what creates the sequencing of returns problem. Take away the need to sell, and you remove the biggest flaw in current retirement income models. What I always tell people is cash flow is the blindingly obvious solution to the sequencing of returns problem among many others. And by the way, if you'd like to learn more about cash flow versus capital appreciation and the other problems, especially for retirees who need to take distributions from their portfolio that cash flow may be able to solve as part of a retirement portfolio, then I'd recommend a free special report from Snyder Advisors, my firm, titled How to Not Just Survive But Thrive in Turbulent Markets. To find that, go to either kimsnyder.com or snyderadvisors.com. Look for free investor resources, and then what you want is really good free stuff. That's what you're looking for. It'll say special reports. Click on that and you'll find that How to Not Just Survive But Thrive report right there in the special reports. When planning for retirement, what you need to be aware of is that you are seeking solutions to a relatively new problem. It's only in the last 10 to 15 years that academics have seriously begun working on the problems created by our need to self-fund what is likely to be 30 years or more in retirement. In 1935, when Social Security was first created, the life expectancy at birth of American men was about 58 years. Today, the life expectancy in the United States, according to the CIA World Book, is 78.24 years and continues to climb. It's only been since the late 1980s that IRAs and 401ks became commonplace. And as late as 2002, when I first started lecturing on the topic, most people had never even heard of the 4% maximum sustainable rate of withdrawal. When I would tell people about it back then in 2002, their jaw would drop to the ground. Today, almost everybody who's at least approaching retirement age has heard of that 4% rule. The financial services industry has a tendency to try to shove square pegs in round holes. The incentives of the compensation system that are pervasive in the industry just don't reward fresh thinking. Old ways die hard, especially when they're lucrative. You live in a desperate housewives world. Leave It to Beaver solutions to retirement planning are far too dependent on luck, as I just showed you. To solve today's most pressing retirement issues, you're going to have to think and act different than your parents and grandparents did. And that is likely going to mean thinking for yourself.